Hi, this is the Doctor from fxsignaltrader.com. What I found is that the better grounding you have in the basics, the better your rewards will be in the future. Even experienced traders have some aspects of their chart recognition not up to scratch. This isn't an error or anything like that. It's just that some traders have chosen a certain path, a certain strategy to follow in the early days of their career, and they've never actually looked at anything else. What I teach are the absolute basics and fundamentals, and once you get this down, the more you practice, the better you get. You will eventually become very proficient at not only following the signals, but actually maximizing the results from the signals. Right, what you have in front of you are some fairly basic chart patterns. You see them time and time again, and it's important that you recognize them. Here you can see a consolidation. It's just cycling. Sometimes it stays within a range. It can be a completely horizontal range, or in other cases this pattern here may be sloping downwards or sloping upwards. It doesn't really matter, but the key is to identify a movement in a range like this. Normally when that happens, at some point in the future it will break out, up or down, just dependent where the market wants to go. So that's fairly key to recognizing that in the market. Here you can see an impulse move going up. When I say impulse, it's a strong move without looking backwards. It's not cycling, it's just moving straight up. And here you can see it forming a consolidation. You just draw your lines based on the pivot, the low pivots formed and the high pivots formed. And at some point now, it's either going to break to the upside or the downside. Now, when you have an impulse, a greater chance of breakout is always to the direction of the initial impulse. So here, I would expect the breakout to be to the upside. Now here, we can see a strong move. We've had this impulse move up. If we were to get an order to buy at this level here, now what should we do? Do we think it's a good point to actually buy immediately when we hit that level? Well, you could do that, but as everyone knows, after a strong impulse up, there almost certainly always is a retracement and then potentially a break up again. So, if you have a strong impulse, which is clearly above any previous level, then you would do very well to do a pip improvement trade. You could enter part of your position at this point, but you'd do much better to actually wait for a retracement and get in at a better price and then follow the trade up. Similarly with these, because of the price action here, I'd be inclined to take the trade directly at the price indicated, because you're likely to get an explosive breakout which may not look back and give you another opportunity. Similarly on this chart pattern here. So let's go on and look at some more chart patterns. Right, so different techniques of entering our position. If for instance it was cycling up, we had a position to buy there. We could take the signal price and actually buy at this price. But what you could do is just take part of your entry at that price. You can choose what that entry is in terms of the lot size, but you could choose to just enter part of your lot, whether that's 50%, 60%, 70%, 80% of your size that you would finally want to have. Is up to you. You need to experiment and see what suits you best. So you take a partial entry there to ensure you're in the trade, and then when price retraces down, when you can get something better, then take another entry there and then you're in it. Similarly here, if the price action is like this, then again you would take your entry at the predefined point there at whatever percentage of your final lot size that you would like. In this case, the chart simply went off. It didn't give you another opportunity to do a price improvement at all, but it doesn't matter. If you take a partial entry here, then that gives you the psychological feeling that you're in the trade and you're not losing out on the trade. And that is very valuable, because you're not then trying to chase an entry that you may have missed otherwise if you were waiting for price improvement. Let's move on to the next one. Here we had an opportunity to get in at an even better price. You would have taken initial entry here, and then potentially, well, nobody knows when it's going to turn, So it's up to you. You just simply wait, and when you think you've got the best price, maybe you wait for the red candles to finish and a bullish candle to appear, and then you take a price that's better. It's up to you, but the more you watch the charts, the better you get at this. So I hear you thinking to yourself, well, it's all very fine, Brian, telling me all this, but how do I know if it's going to come back? Or how do I know if I'm going to get a chance to get in or not? Well, I'm going to get onto that now. But the key thing to take from this slide is take a partial entry and then wait to get a better entry. If you do it this way, then your chances of getting in at a worse price if you miss the initial entry because you're waiting for a retrace would go away. If you take a partial entry, you're in the market and then you're just waiting to improve on that. You're scaling in. If you do this, then your chances of taking other worse entries are probably less likely. So let's look at the next chart. If you look at this part of the chart on its own, it really doesn't tell you much information. So you don't quite know whether you're going to get a chance for a price improvement or not. So what you should do is zoom out with more bars on your chart. This is an enlargement of a bit more of the chart, and it's just a random example. So here you can see you had some cycling here. This is a key area where resistance forced the market down. It bounced, it wouldn't allow it to go above it. And here you can see also there was a breakout to the downside. But as we approach this level again, we've got a signal to go long. Now what do I do? Well, we know that it's bounced previously at this level, so therefore our expectation is that it's going to bounce again and then maybe go off. So we have a high likelihood that we're going to be able to improve the price should we enter this trade. There we have it. Just looking at some history that's gone on before, and there's some complex analysis you can do around this. You can look back over hour charts instead of 15-minute charts and get some key levels of resistance and support. But this is additional training. You can go off and do that in your spare time. I'm just giving you some key pointers here. So let's look at another example. Okay, in this chart, again, you can see exactly the same portion that you saw in the previous one, which is here, except I've changed the history. Here you can draw some clear lines. You can see that it had entered a consolidation. This can be pointing up, down or sideways, doesn't matter. If you get an entry on one of these, then the likelihood is that it's going to take off because it's going to break out from this tight range. The tighter the range and the longer it's gone on for, the more likelihood that it's going to break out explosively in one direction, and generally the same way as the initial impulse, which is upwards. So here, the likelihood of it giving you a chance for a pip improvement is less likely. So you would enter and you wouldn't really be expecting a price improvement. You'd be expecting it to go off. Unlike the other example, just by looking at the past history of the chart, you can see what kind of price action you're going to get. Let's take another example. Here we can very clearly see that the market, well, it could have been forming a large time frame triangle, or more likely it's possibly in a sideways choppy market. In such a market like this, you expect price to really carry on doing what it's doing until it gets maybe to this region here where there's previous resistance. So we get a buy entry here. What do? Well, we expect it to be moving around. So we expect to get a very good price improvement. We expect it to maybe do something like this. It may go on sideways for a bit, but eventually our system tells us we want to be in a buy position. So what we want to do is maximize that. We don't expect to enter immediately. We expect some price improvement. Maybe a considerably larger price improvement may even come down to here and retest the extreme of that range, or maybe this line here I've drawn. From this, from what I've just shown you in just a few slides, you can very clearly see the power of identifying the previous price action and the chances of a price improvement. So take this away, practice it. Cheers and good trading to you.